Financial assets have appreciated since March of 2009. In 2018, we have seen market turmoil which has become persistent and pervasive globally. The world is certainly different in 2018 than in 2017. Much more volatility is present and conditions seem to be worsening. What will the Fed and other central banks do in response? You came here for the truth, so let me unveil that for you today. We are going to look at the stock market. We're going to talk about what's going on in China. I also want to get into retirement accounts. So much more to cover. Let's begin with this. Chart of the week. First half sector flows. We're talking about U.S. equities right here, and there has only been one buyer, and that is corporate buybacks. Corporate buybacks have literally held the market up in 2018. I want to focus on something, not just who is the only buyer, but what else is being sold. Take a look around, and you can see this. Institutional investors, hedge funds, and so on are selling everything except for industrials. We see that's the only anomaly in this case. Whether it's energy and utilities and so on, it looks to me like everybody is selling off. Corporate buybacks are literally keeping the market afloat here. In 2018, we can see that, for example, tech stocks have risen considerably. That's a fact. But who's buying? People think that it has to do with the stock's fundamentals. Of course, when they do so, they happen to leave out things like PE ratios and other things that are gone absurd at this point. But we are looking at this and thinking, okay, Apple is doing really well. Okay, Amazon did an amazing Prime Day sales, and this has been the case. You know, they're selling so many products and more businesses are going online. Online is the way to go. Apple makes the best phones. Their sales are up. Their production is doing well. No problems. And this is the reason why these stocks have risen. Is that really the case? Is that really the reason? Is the performance of a company the reason why stocks go up? If we're still believing that in 2018, we're definitely ignoring a lot of the data. We are ignoring, in fact, all the truthful portions. If you're getting your information from those textbooks they gave you in your economics training throughout school, you're getting it from the wrong source. If you're getting it from your television, from your newspapers, you're getting it from the wrong source. You need to understand what has happened historically and then look on the day-to-day news. That's what I try to do, is break down the day-to-day news as it happens so that you can see and decide for yourself. That's what I'm doing here. I'm showing you this. CNBC, Bloomberg, they will not show you this information. Okay? It's only in reports that only select people are getting, and then it's distributed through other means. So we can see this information and understand, look, corporate buybacks are what's keeping the market afloat at this time. We know that central banks are holding on to massive quantities of shares. That is a fact. But in terms of the purchases here, we don't get to see that information on the chart. I don't know if they've been buying throughout the year. We still have to be able to get that information, which is available in the 13Fs that the SEC publicly displays. However, we don't find until the quarter is over what they had done. That information is always delayed, and actually, in fact, it's usually not given out. We do get little pieces, and I've shown you that here on the channel before, but not all the time. So at least we have this. We know specifically that corporate buybacks are at record highs here. This is going to be a complete anomaly in all the years prior to it in the amount of shares that have been purchased. It's ridiculous, truly. So that's that. But I want to get into some other issues, talking about the central banks and more. Summary of the G3 central banks QE trajectory. We're looking at this information out of Morgan Stanley. They did a report, and I'll just touch on a couple points here. What they said in this, number one, I want to highlight the right-hand side. Timing of the next rate hike by the Fed, supposedly September 18. We'll see that. October 19 for the ECB, and the BOJ is going to be at least 2020, if not further. I think that that's hilarious, but we're going to see how it all comes down. Now, all of these are all betting on the fact that everything is going to at least continue the way it is or get better. We'll see about that. We expect the Fed to increase its reduction in reinvestments in UST and agency MBS to $30 billion per month, respectively, by the fourth quarter of 2018. So we're told it's going to be $50 billion. We were told it's going to go up to $80 billion. Here we are. What exactly is the deal? They said they would have started it in October. We didn't see anything meaningful, really, as of yet. That said, we expect the Fed to end the balance sheet normalization in September 2019. That's interesting. I covered that just a few days ago, in fact, how they believe that at some point it's going to have to stop and then reverse. They're going to have to continue that expansion if they want the market to stay afloat. And that is something I completely agree with. The timing-wise, I'm not so sure. I don't know when this will happen, but in fact, it is important to address it as it comes up, okay? We expect the ECB to reduce its net purchases to 15 billion euro per month between October and December from 30 billion currently, and then discontinue them in 2019. How in the world? How in the world? Whether you are in Europe, whether you are in the US, Canada, anywhere. How is this possible? The ECB, of all of the central banks, how are they going to stop printing money? You have massive deflation. You have high levels of unemployment going on, and yet you're going to stop your asset purchase program? Are they insane? Unless they want to create a crisis. We expect the BOJ to adjust the 10-year JGB yield target, widen the band margin around 0% to around 0.15 and so on in January, March of 2019. So they're actually going to go into the positive territory. Can you believe that? Wow, excellent. So they believe that all of this is going to be able to be normalized in the next little while. I completely disagree, of course. That doesn't surprise you. One of the most important things to understand about central banks is that they create liquidity. They are the reason why stock markets go up and down, not how many phones Apple sells, not how well Amazon does on Prime Day. We're talking about liquidity. And you'll see that here, there is this overall liquidity dry up that is occurring today. And that is, in fact, the case, particularly with the Federal Reserve. The whole market, the whole world is relying on it. You could see several emerging markets have come out and told the Fed, told the US, do not stop printing money because it's going to hurt markets globally. And of course it will. And I'm glad that at least somebody is pointing it out, because we know that that is the case. Now, Morgan Stanley had something to say here. I'm just going to touch on just what they said in this paragraph. As traditional banks pulled back, central banks became significant market players, accumulating quantities of assets over the last 10 years. Central banks hold 28% of the agency MBS market, the Fed, 22% of the European sovereign market, the ECB, and about 10% of the European IG credit market, the ECB again, and 42% of the JGB market of the BOJ. Now, we're talking about central banks basically owning a large percentage of the market. We're not talking about 5% or 10% even. We're talking about large quantities of the market are being owned by central banks, printing up money, buying this garbage up, and that has completely and permanently distorted the market. There will be no possibility of turning it around. It's just not possible. But of course, that is the intention. It's built in there to fail so that we can set up a crisis and, of course, have the solution provided. Don't go anywhere. Make sure you watch part 2 of this video. I'm going to get into so much more detail. Make sure you click on the link in the description to take you over there, and I'll see you on the inside.